This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Fabulous February stocks finish the month with solid gains of 5% or more. Will the bulls continue their march into March?
Downsizing dilemma. Pending home sales may have risen this month, but the numbers are still relatively weak. And baby boomers could be part of the reason why.
TikTok, the House tries to avoid a shutdown of the Homeland Security Department, but it is turning out to be no easy feat. All that and more tonight on Nightly Business Report for Friday, February 27th.
Good evening, everyone. The bulls came out of the cold in February and heated up the stock market. The Dow Jones Industrial Average and the S&P 500 had their best February since 1998. Both indexes closing at record highs a handful of times this month. And the Nasdaq inched ever closer to a level many of us thought we'd likely never see again, 5,000. And it wasn't just stocks. Oil, which had been on a downward trajectory, may have found a floor, scoring its biggest monthly gain since 2009. So for the month, the blue chip Dow index rose more than 5.5%. The Nasdaq gained 7%, its best month since January of 2012. And the S&P 500 also rose about 5.5%. And all this came despite a pullback today, with the Dow falling 81 points to 18,132, the Nasdaq down 24 points to 4,963, and the S&P 500 lost 6 points. Dominic Chu takes a look at what was behind the February surge and some of the big events that loom ahead.
After a rough start to 2015 in January, the market staged a comeback. And now this is one of the best Februaries on record. At certain points, we hit historic highs for both the Dow Jones Industrial Average and the S&P 500. Even the Nasdaq Composite is inching closer and closer to records we haven't seen since the internet stock bubble back in 2000. So, does February's positive momentum give some investors a better feeling about the rest of the year?
Absolutely. I mean, I think in some ways February is the new January, and having a great February is a wonderful way to start the first quarter, and certainly we expect the momentum to continue.
Recent history is siding with the bulls. According to market data and analytics firm Kensho, March has been positive for stock investors over the past 20 years. On average, during that span, both the Dow and the S&P 500 have gained north of 1.5% and have been positive at least 70% of the time. But historical performance is no guarantee of future results, and big unknowns still remain.
I think right now the biggest risk for the market is a policy mistake on the part of the Federal Reserve. There's so much attention on the Fed right now, when they will raise rates, how quickly they will raise rates. So the communication strategy has to be spot on in order to set market expectations around that. We have some good historical precedent that suggests that if we don't get good communication out of the Fed, the markets can really get very volatile very quickly.
Interest rate policy isn't the only worry. There are still issues like Greece's financial woes, falling energy prices, and geopolitical hotspots in Ukraine and the Middle East. So, if the rest of 2015 is anything like the first 2 months of the year, we could be in for a very bumpy ride. For Nightly Business Report, I'm Dominic Chu.
Art Hogan here now to discuss what lies ahead for the markets in March. Art, good to have you with us. Was January the anomalous month, or was February? What do you think?
Well, it's interesting, Tyler. When you look at the way that we ended the year, we probably pulled in some of those gains that would have otherwise happened in January in the month of December. We really finished with a bang last year. The months of November and December were very strong. So not surprisingly, we started off on our heels and really didn't quite get started until February. But what's even more intriguing is how much bad news or how many sort of concerns we worked our way through in the month of February, and yet the market still had a really terrific month. So when you think of things like a daily worry about Greece, Russia, Ukraine, volatility in the energy markets, although we seem to be in a bottoming pattern, but we certainly saw a great deal of volatility. And we had to work our way through an earnings reporting season that saw the energy patch, that 13% of the S&P 500, really come under a lot of pressure. So, considering all the geopolitical concerns we had and the fundamental concerns, February was a fantastic month for us, and hopefully we're off to a good start in February and we kick back in next week.
Those concerns are not really going to go away in March. So what do you think are the fundamental drivers of stocks as we go into this new month?
Well, so you bring up a good point, but I think some of those hurdles are at least, on page 2 of the news cycle. So, for example, we're not worried about a Grexit, right? So we've got a deal that has put that worry behind us, at least for 4 months and hopefully for a while. And, when you think about Russia, Ukraine, the ceasefire seems to be working. We hope that that holds. But I think what's really going to kick in is we've already seen what happens with low energy prices on the negative side. We've seen rig counts coming down, CapEx coming down, energy companies reporting lackluster, if not bad, earnings. What we haven't really seen kick in to a great extent is that positive influence, which would be consumer spending is going to continue to pick up. It started in restaurants. It's going to work its way into specialty apparel, into the department store. We're going to see things that we haven't seen in the first 2 months of this year because consumers are getting used to lower energy prices. There's more of them working, and we have the highest level of consumer confidence that we've had in about 10 years.
Art, I saw some numbers today forecasting second quarter corporate earnings and that the comparisons to last year were not going to be particularly good, largely because, as you pointed just a moment ago, energy companies' earnings are not going to have favorable comparisons. Can the market keep moving? Can the market keep moving higher if the overall earnings growth isn't there?
Well, I'll tell you this, and I think that's very true. If you look at the downward revisions we've seen for the S&P 500 earnings, in large part it's coming from 2 of the 10 sectors. It's financials who still don't have net interest margins yet. We haven't seen interest rates go up. We have a very flat yield curve, so it's difficult to make money as your typical regional bank or typical financial. The other piece of the puzzle is energy, and that's going to continue. Energy earnings are going to be a drag on the S&P. But remember, the energy sector of the S&P is about 13% of it. So when you think about that, you've got the bulk of the S&P, which benefits in large part from the lower energy prices that will probably see earnings estimates go higher as we work our way through the year. So my guess is we're probably overdone in terms of the pullback in estimates for the S&P 500 on balance.
So where would you put money to work, Art? I know that consumer discretionary is one area that you've liked in the past. Do you still like that? And would you stay domestically oriented, or would you perhaps go overseas and maybe look at Europe, as some are doing right now?
So those are 2 great questions, and we still like the consumer-facing stocks, restaurants like Sonic, Jack in the Box, Cracker Barrel. They've all reported great earnings. They continue to have tailwinds. Consumer-facing stocks like Deckers and Steve Madden's Shoe. We like the folks that are producing things in dollars and selling them in dollars versus people that are making things in dollars and selling them in euros. So we look at companies that have a lot of FX exposure to Europe and try to stay away from that. And the other thing, in terms of European multiples, it looks very attractive. So for a balanced portfolio for the balance of this year, we would say that if you have 65% allocated to equities, you want to look at 15 or 20% of that being put in European stocks. They're getting stimulus as we speak. Their QE kicks off in March. Their multiples are very reasonable, and you probably want to do that on an ETF basis versus a single stock basis. So I think looking at Europe is going to make a great deal of sense this year. They've already had some outperformance. They've moved about twice as much as the U.S. markets. I think there's a lot more to come. So I think it's a rational expectation to think you should be facing Europe a little bit this year.
Art, always great to see you. Art Hogan with Wunderlich Securities.
This evening, the House tried and failed to pass a short-term funding bill for Homeland Security. The wrangling continues as the clock heads towards midnight when that funding runs out. John Harwood has been covering the story for us from Washington. And John, as you correctly predicted last night, this one's going to go down to the wire, and it's going to be very tense.
It is, Sue, and this is a stunning repudiation for House Speaker John Boehner from his own members, more than 50 of which voted against this short-term funding proposal that he had come up with as an answer to what the Senate has done. There's going to be more back and forth. The House is figuring out what its plan B is going to be, but this is going to be very difficult, and it's a bad sign for getting further things done in the Congress, like corporate tax reform. Now, one of the things fueling Republican willingness to let this happen is that the belief that Homeland Security isn't really going to stop because so many are emergency employees. Here's Senator Orrin Hatch, the chair of the Senate Finance Committee, when I talked to him earlier today on the consequences of not funding this department.
DHS will run, completely run. There's not going to be a loss of personnel or a loss of time. Some of the executives will have to work and get paid later. But it is essentially self-funded. So anybody who wants to make a big fuss about that really doesn't understand the budget, doesn't understand the self-funding mechanism of DHS, the Department of Homeland Security.
And I think, guys, that Orrin Hatch is right. This is going to have more political repercussions than it does security repercussions, which is why Republicans are still working on it, trying to find a solution tonight.
New Congress, but it seems some things stay the same. John, you referenced a Plan B that you said the House is trying to come up with. Do we have any idea what the outlines of a Plan B would be, or do they have them?
They don't have one. And the Senate has a plan, which Mitch McConnell put forward as a way out of the box that they're in, which is to pass a what they call a clean Homeland Security funding bill through the end of the fiscal year. But if John Boehner couldn't pass a 3-week extension of funding, he certainly can't pass with Republican votes a extension all the way through the end of the year. So what that means is Boehner is, if he chooses to do that, and that's one out for him this evening, if he chooses to take it, he's going to have to put it up, get a few Republican votes, count on Democrats to pass it, and that would be a further embarrassment.
What about the president? He said that he won't let the Homeland Security Department shut down, and if the bill does come to his desk, he'll sign it. But it seems as though this little bit of disarray on Capitol Hill gives him some ammunition.
There's no question about it. And the bill that he said he would sign was that 3-week bill, which has now gone down. So that's not an option. The only live vehicle at this moment is the extension through the end of the year. Democrats want that. Mitch McConnell put that forward as the leader of Senate Republicans. If the House takes it up, it will pass, but it'll pass with Democratic votes, and that's something that John Boehner would like to avoid if he can avoid it.
All right, John, thank you so much for walking us through that. We appreciate it. John Harwood in Washington. To the economy now, which slowed more than initially thought in the fourth quarter as business investment decelerated and the trade deficit widened. According to the Commerce Department, gross domestic product, which is the broadest measure of goods and services produced across the economy, expanded at a 2.2% annual pace. That's revised down from the 2.6% pace estimated last month.
The president of the Federal Reserve Bank of New York urged caution on raising interest rates. In a speech today, Bill Dudley cited uncertainty about the sustainability of the economic recovery. Meantime, Fed Vice Chair Stanley Fischer, in an exclusive interview with Steve Leisman, said he sees a rate rise sometime this year.
Yeah, I think there's a pretty high probability that this is the year. We're very close on unemployment, and inflation is in a situation where it's low because of oil prices, but we expect it to go up once this effect wears off, which it should do in a couple of months. So it's about time.
It's about time. Fisher also defended the central bank's stimulus program, saying it played a crucial role in helping turn around a very weak economy.
Some not so hot news out of the Midwest. Economic activity in that region unexpectedly contracted in February, tumbling to a 5.5-year low. According to the Institute for Supply Management's latest Chicago Purchasing Managers Index, the West Coast port strike and the harsh winter weather in parts of the country had a negative impact.
Homebuyers came back to the market in January, signing more contracts to buy existing homes than they have in a year and a half. The National Association of Realtors monthly index of so-called pending sales, deals signed but not yet closed, it's an indicator of future closings, rose 1.7% last month. Now, despite the gain, the numbers are still relatively weak, and one reason is lack of homes for sale. Supply is limited by several factors, but one directly related to downsizing baby boomers. Diana Olick explains.
Betsy Friedlander and Mike Clipper have adored their light-filled 3-story colonial in suburban Bethesda, Maryland for nearly 3 decades. They raised their 2 sons in it. But now, with the boys grown and gone, they're looking for a new home as part of a new lifestyle.
I think we wanted to have more of an urban life. If we could be downtown where we could walk to everything, I think that was a preference for us.
But after an exhaustive search of condominiums and townhomes in downtown Washington, D.C., and in downtown Bethesda, they learned a tough lesson about this new lifestyle. It has become incredibly expensive.
We were shocked because we thought, well, we would be able to sell our house, maybe put a little money in the bank and buy something that we could be comfortable in.
Everything, she said, was so tiny.
We couldn't even figure out how Mike could watch TV and I could be asleep at the same time.
So they gave up, like so many baby boomers are now doing, which is causing an even bigger problem. You see, downsizing baby boomers were supposed to fuel the nation's anemic housing supply dramatically, making way for much-needed new buyers. But listings are now down 9% from a year ago, and there are still too few of these coming on.
So the houses that were waiting to come on the market for the young families who are trying to move into the good school systems and the good neighborhoods aren't coming on.
Real estate agent Jane Fairweather says at least half of her baby boomer clients cannot afford to move, and that is limiting her listings.
They are looking at getting out of their 5,000 square foot house and going to 1,600 square feet and having to add almost $1 million to the price in order to buy less space for a lot more money.
Boomers like Betsy and Mike are now aging in place.
I think we feel healthy now, but I don't know, if 10 years from now, one of us would have trouble walking the steps.
But they know all too well they can't do that forever. For Nightly Business Report, I'm Diana Olick in Washington.
And still ahead, 2 companies in the news this week are 2 stocks our Market Monitor's guests suggest you buy. We'll talk to them about why coming up next.
Former AIG CEO Robert Benmosche died today. Benmosche had been undergoing treatment for lung cancer since 2010. He was the insurance company's president and CEO from August of 2009 until last September, helping to steer the company back to profitability after the financial crisis. He was 70 years old. A lawsuit is filed against Apple, and that's where we begin tonight's market focus. Ericsson is alleging that Apple infringed on 41 of its patents. The Swedish telecom manufacturer has also asked the International Trade Commission to block Apple products in the U.S. Apple also filed a complaint against Ericsson last month. Shares of Ericsson were up a fraction to $12.93, and Apple 1.5% to $128.46 to the downside there. Sprint's chief executive purchased more than 5 million shares of his company's stock this week. According to a regulatory filing, the CEO paid about $25 million for the shares, purchased at an average price of $4.92. Shares sprinted higher by more than 7% to $5.12. Ty? One stock, Sue, with a hulking move. Monster Beverage, after investors react to the energy drink maker's strong earnings from last night. The company attributed some of that strength to continuing international sales growth. Monster also said that it and Coca-Cola have expanded some aspects of their strategic partnership. And that boosted shares of Monster up 13% today. They finished at 141.12, and Coca-Cola, Coke there owns a 16% stake in Monster. It was up 2% to 43.40. And the publicly traded investment firm of Carl Icahn suffered its first annual loss since 2008. Icahn Enterprises says the collapse in oil prices was the main culprit. However, the performance of Apple shares, which is the fund's largest holding, helped mute the impact of falling oil. Icahn Enterprises off nearly 2% today to 97.67. And now to our market monitor, who's positive on equities and has stock picks he says will benefit from the strong U.S. economy. Eric Ristobin, Chief Investment Strategist with Russell Investments. Eric, welcome back. Great to see you. Talk to me about your view of stocks for the remainder of this year.
Look, we like stocks. We think they're going to be higher at the end of the year. If you're looking kind of to trade this, they may trade sideways until we see first quarter earnings, because the market is very concerned, particularly about U.S. stocks, ability to weather a strong dollar, and it's also worried that some of the weakness economically outside the states is going to actually affect U.S. companies more than anticipated. We don't think so. That's why we think we're going to be higher at the end of the year.
What about interest rates? You know, the debate this week was whether or not we're going to see a rate hike this year. Stanley Fischer weighed in on that with our Steve Leisman, saying this is probably the year. Does that worry you, or do you think the market has clearly factored that in?
Well, no, it doesn't worry me. It's actually what we're expecting. We think it's going to be in the third quarter. We think that the combination of better employment and wage pressure are going to start pushing inflationary pressures into the marketplace. You know, Mr. Fisher obviously talked about the fact that the commodities deflationary forces are subsiding. We think the wage pressure is going to actually take over, and the Fed will move in the summer.
All right, let's get to Eric. Let's get to some of your picks here. You got 2 out of the 3. One, a cybersecurity company. The other, a victim of a cybersecurity hack. Let's start with a security company, and that is Proofpoint, PFPT at 5678.
Right, they're a small company. They're focused, therefore, mostly on the U.S. market. You talked about the cyber problems that a lot of companies have had. Cybersecurity is a growing industry. Proofpoint is growing in market share in that growing in that growing field, and we think because they're domestically focused, they don't have any dollar effect on their earnings. We think there's a really rosy future for them, and they're probably a takeover target.
Well, let's talk about about Target, now that you mentioned Target, because that's also on your list. Why do you like it?
Well, one of the reasons is it did not have a great year last year. A lot of consumer discretionary stocks had a tough year last year. We think that with a combination of lower fuel prices, giving the consumer more spending money, along with the fact that more consumers are employed because employment's significantly better, that's going to lead to consumption. We think Target, being a primarily domestically focused retailer, is going to do well and is well positioned for the kind of people who are going to spend in 2015.
Your third choice is Southwest Airlines, in the news earlier this week for having missed or postponed some inspections on its aircraft. Look at that run-up. It has almost doubled, Eric, in the past year. Does that kind of price spike worry you?
Well, it came off a relatively low base. Obviously, it was a better deal a year ago, but we still think it has more to run. One, we think energy prices are going to stay relatively low for a long time. Two, it's clear consumers, as one of your earlier guests said, are spending their money on experiences. Dining out is one of them. Travel, we think, is going to be the other one. We think a direct beneficiary is a domestic air carrier that has, again, no dollar revenue exposure to speak of. I think we're going to do well with that stock.
All right, Eric, thanks very much. Eric Ristabin, Russell Investments.
And coming up, startups aren't just flocking to San Francisco and San Jose anymore. They're finding less expensive areas, and where they go, the venture capital money follows.
Well, we're about a month into tax season, and the average federal tax refund, see if you can guess, $3,120. The Internal Revenue Service says it has paid out $125 billion in refunds so far. That's roughly equal to last year's pace, but the refund trend may not continue. Statistically, it is the early filers who tend to be those expecting a refund, so they get in early.
Figures. When you think tech startups, you probably think of San Francisco or San Jose, but those cities are starting to see some new competition on the other side of the bay. And as Josh Lipton reports, where startups go, venture capital money follows.
The real estate market is now so red hot in San Francisco that it's motivating startups to move to the city across the bay, Oakland. The difference in the cost to rent office space is huge. In downtown Oakland, the average asking rent is $34 per square foot. That's nearly 50% less than downtown San Francisco. Property managers in the Bay Area say that difference is a big draw for startups.
Definitely cost is a pro. It's an advantage. We're less expensive here in Oakland. It's sunnier here in Oakland, so I think that that's a good advantage. And it's got a real authentic feel. So we have a lot of open space, a lot of brick, a lot of old buildings, and I think the new startups tend to like that creative space that Oakland has to offer.
And where startups go, venture capitalists follow. VCs invested more than $1 billion into nearly 100 companies in Oakland last year, according to the Money Tree report. That made Oakland the 7th most popular spot in the nation for VC investment, right behind Seattle and ahead of Chicago. Startups like Captricity, which is headquartered in Oakland, say that beyond the cost of doing business, there's another attraction of calling Oakland home: the camaraderie of the tech community here.
You also get a tight-knit community. So we have parties here on our patio for the local startup scene. The mayor's very supportive of Oakland startups. And you even have bigger companies in town like Ask.com and Pandora, which is just next door.
Still, Oakland faces real challenges before it becomes the next tech hub. The most glaring problem? Crime. Oakland has the highest robbery rate in the state of California, according to the latest data available from the FBI. So, no surprise, the pool of tech companies in Oakland is still small. But economists think more startups are coming to Oakland as surrounding cities become just too expensive. The average asking rent in downtown San Francisco is now more than double the national average. For Nightly Business Report, I'm Josh Lipton in Oakland, California.
Finally tonight, the dress made famous by the internet. Have you seen it? Have you heard about it? Sparking a social media debate over whether it's blue and black or white and gold. It is now a hot seller for the company that makes it. The British clothing company said the 300 dresses on its website sold out in a half an hour this morning, but they were able to find other inventory. Traffic to its site has soared, and this morning they got 150 calls in 45 minutes. Is it white and gold or blue and black? So whether you think the dress is blue and black or white and gold, it is all green for the Birmingham-based retailer. I saw it as white and gold.
You did?
I did indeed.
I saw it as blue and black. How could you see it as white and gold?
That's a beautiful orange vest shirt you wear there, right?
Well, to each his own. All right. That's Nightly Business Report for tonight. I'm Sue Herrera. Have a great weekend. Thanks for watching.
And the same from me. I'm Tyler Mathisen. We'll hope to see you right back here on Monday night.
How could you see white and gold?
I saw